Hello everyone! Today we're embarking on a deep journey into the mind of Tom DeMark, one of the most mysterious, debated, and essential figures on professional trading desks. We are going to explore his trading secrets and the philosophy behind his approach. If you've ever felt like the indicators on your screen were constantly leading you astray, if you've ever sold at an oversold signal only to watch the price stubbornly keep rising, what we're going to discuss today might fundamentally change how you look at the markets. DeMark offers us more than just an indicator. He offers a vision that teaches us how to read the market's biological clock. So, without any interruptions or headings, let's begin exploring that fine line where classic analysis fails and market timing begins, from its most basic foundations to its most complex details. Anyone who has spent years in the financial markets has one phrase burned into their memory: the trend is your friend. At first glance, this seems perfectly logical. Often, it even makes money. However, experienced traders know that, like any friend, a trend can abandon you at your most vulnerable moment, when you least expect it. This is exactly where Tom DeMark enters the stage. He isn't a crowd follower chasing trends blindly. He is a master of timing who tries to measure when a trend is getting tired, when it is literally running out of breath. DeMark's approach to technical analysis is, in many ways, a fundamental protest against the classic indicators most of us use today. While oscillators like the RSI, MACD, or stochastics tell you where the price has gone, DeMark has always focused on one specific question: is this move still sustainable, or is its time simply running out? This question is the core difference that separates him from a standard technician and turns him into a market strategist. For DeMark, the issue is never about direction. It is about mathematical and psychological timing. DeMark's starting point was a revolution in the world of technical analysis, the idea that the market is unpredictable, but it is timable. Most traders spend their entire lives trying to answer the question, where will the price go? Tom DeMark, however, was never primarily concerned with the ultimate price target. His obsession was whether the current move still had a high statistical probability of continuing. Classic technical analysis seeks direction. DeMark measures endurance. Classics ask, has a trend started? DeMark asks, how much more pressure can this trend withstand? This is why he was never a trend follower. He became known in the literature as an expert in trend exhaustion. To him, being in a trend isn't the skill. The real skill is recognizing when that trend has turned into irrational exuberance or illogical fear and knowing exactly when to step off the ship. The great secret of this system is the discovery that time is as important as price, and sometimes even more so. Before DeMark, most indicators focused on only two things: where the price went and how fast it got there. DeMark added critical new dimensions to this limited equation. How long has the price been moving in the same direction? How many times has the same behavioral pattern repeated consecutively? Is the market still behaving normally, or is it struggling like a vehicle with an overheating engine? Because of this perspective, DeMark's indicators differ from traditional momentum gauges. They don't predict volatility or follow trends. They directly measure the market's patience and psychological limits. Think of a marathon runner. DeMark doesn't look at how fast the runner is going. He looks at how many miles they've been running without a break and when their legs start to tremble. If a runner sprints in the final mile, a classic analyst sees strength and assumes they can go much further. DeMark sees a climax and knows they will collapse right after the finish line. The numbers 9 and 13, which are so famous and perhaps so frequently misused in the trading world, are not magic wands. They are behavioral filters. This is the most misunderstood point. DeMark never said, just buy when you count 9, or sell when you count 13. These numbers represent how consistently and uninterruptedly the market has behaved in a single direction. It is a behavioral counter that shows whether market stability is increasing or if market stress is reaching a breaking point. DeMark emphasizes that a signal is read by the context, not just the number. If a trend produces the same relative closes for 9 consecutive candles without deviation, it isn't necessarily a show of strength. It is the beginning of an exhaustion signal. It's not a math game. It's a map showing when the crowd is about to get exhausted. At this point, the trader's job isn't just to count, it's to analyze the market conditions in which those numbers appeared. The sharpest difference between DeMark's system and the thousands of strategies you see online is that he never accepts a signal without a cancellation level. A common mistake in classic technical analysis is getting excited by a signal, entering a trade, and only thinking about the stop loss later. When a trade goes wrong, most analysts make excuses, saying the market was wrong. DeMark rejects this. According to his approach, if you haven't defined exactly where you are wrong with a precise mathematical line, then your correct signal has no value. This is why TDST levels, risk lines, and invalidation levels are not visual decorations in his system. They are the heart of it. This approach makes him not just an analyst, but a risk management genius. DeMark's systems tell you, above all else, where you will be wrong and where you must exit the market. Many amateur traders complain that DeMark's signals often come too early. In reality, this isn't a flaw, it's a conscious design choice. DeMark's goal was never to be a hero by catching the exact top or the exact bottom. His goal is to report when the risk-to-reward balance has deteriorated and when the cost of staying in the current direction has become higher than the probability of winning. It's not just a trade order, it's a vital position warning. When you're approaching the edge of a cliff, DeMark tells you to stop 10 feet before you fall. Most traders want to go to the very last inch, so they see this early warning as an error. However, professional fund managers and institutional trading desks prefer DeMark for exactly this margin of safety. They deal with massive positions that can't be exited in a single second. They need to know when the climax is coming so they can provide liquidity to the latecomers and exit their positions gracefully while the price is still moving in their favor. So, why is DeMark so widely used on institutional desks while individual investors struggle with it? Because DeMark requires patience, filtering, and above all, the ability to read context. The individual trader usually wants to catch a trade on every candle, see constant action on the screen, and get rich from a simple buy-sell arrow. DeMark is the total opposite of this action-at-all-costs mentality. An institutional trader manages a position, reduces risk incrementally, and plans exit times days in advance. For the corporate world, DeMark is less of a signal generator and more of a navigation system used while managing massive portfolios. While the big players are offloading their assets on that 13th candle, where the market finds its very last buyers in a state of euphoria, individual traders are usually getting swept up in that same excitement and buying at the very top. DeMark ensures you don't fall into that trap. In academic circles, tests performed on DeMark indicators sometimes yield mixed results. However, the biggest mistake in these studies is testing these indicators as if they were simple, mechanical robots. DeMark never claimed his system was an automatic money printing machine. He argued that he could tell you when the market was showing an anomaly, and the rest was up to your market knowledge. For a real trader, academic backtests often matter very little because DeMark is not a strategy. It's a decision support mechanism. A surgeon's scalpel cannot perform surgery on its own, but in the right hands, it saves lives. DeMark indicators are exactly like that. They are tools of precision that require a skilled hand to guide them. The real trading secret behind all these complex systems, numbers, and lines actually rests on a very fundamental truth. Markets are made of people, and people get tired. Algorithms may change, transaction speeds may drop to microseconds, and new financial instruments may be invented. However, the cornerstones of human psychology, greed, fear, persistence, and stubbornness, have not changed for thousands of years. DeMark doesn't measure the price itself. He measures this unchanging psychological fatigue and exhaustion. This is why his systems worked in the low-volume paper markets of the 1970s, worked during the dot-com bubble of the 2000s, and continue to work today in the hyper-fast crypto markets. Because no matter what the price of an asset is, the emotional capacity and the fatigue threshold of those buying and selling it remain the same. If you have a patient nature, if you can set aside the ego of always needing to be right, and instead focus on just being in the right place, and if you have made risk management a way of life, then DeMark's world will open new horizons for you. However, for those who want to make dozens of trades every day, who follow signals without thinking, or who lack the discipline to wait, these systems will remain nothing more than a confusing mess. A DeMark trader is like a hunter waiting for their prey. They wait for that moment of exhaustion when the market is at its weakest and everyone else is at their most excited. That is when they make their move. In conclusion, we must remember, Tom DeMark does not try to predict the market. He whispers to you that critical breaking point where the market can no longer be predicted because it is too strained. Hearing this whisper is the first step to escaping the noise of the market and the emotional chaos of the crowds. When you start looking not just at direction, but at the market's biological clock and its fatigue, you will be one step closer to true professionalism. When you start using technical analysis, not as a fortune-telling tool, but as an art of probability and risk management, DeMark's legacy will be your strongest guide. Today, we touched upon Tom DeMark's revolutionary strategies and his deep perspective on technical analysis. I hope this information opens a brand new and profitable door in your trading journey. Never neglect patience, timing, and discipline in your analysis. Remember, the biggest winners in the market are not those who know the most, but those who have the best timing. May you have profitable trades and insightful analyses where you always stay on the right side of the curve.